Welcome back. This will be a quick introduction on the modelling and valuation step in evaluating corporate restructuring. Let's jump in. Having learned how to perform a preliminary valuation in the previous step, we now move on to the modelling and valuation step. The main tasks here are to estimate the pro forma financial statements and pro forma WACC of the firm after the announced corporate restructuring action. The process for creating pro forma financial statements depends very much on the type of restructuring and situational specifics. In this lesson, we illustrate the process for an acquisition in 7 steps. We'll be going through more examples in the next lesson. If you recall from the FSA course, the acquisition method requires all revenue, costs, expenses, and income of the target to be combined with the acquirers after the merger is complete. First, combine the acquirer and target revenues and make adjustments for any expected synergies from the merger. Second, combine costs and operating expenses and make adjustments for cost synergies, if any. Combine the depreciation and amortization expenses of the 2 firms. Combine any other income or expenses. If debt is to be used to finance the acquisition, add the estimated additional interest expense on the debt issuance. Estimate the income tax of the merged entity. This should be based on the weighted average tax rates of the acquirer and target. And lastly, if new shares were issued by the acquirer for the acquisition, this number of new shares should be added to the total outstanding shares. From this pro forma statement, we can estimate the future earnings per share of the merged entity. After corporate restructuring, the WACC of the firm may change. If you recall, the WAC is the weighted average of the cost of debt and cost of equity. The change in WACC can be a result of changes in the capital structure weights and/or changes in the cost of debt and cost of equity. For example, if a company acquires another company using cash entirely financed with debt, the capital structure will shift from equity to debt as debt increases. Conversely, if an issuer sells a division for cash and uses that cash to retire debt, its capital structure will likely shift from debt to equity. While it is easy to estimate the change in capital structure weights, estimating the effect of restructuring on the cost of debt and cost of equity is more difficult. In general, change in profitability, change in volatility of earnings, and change in leverage after the restructuring can affect the company's cost of capital. These can be measured by changes in EBITDA or EBIT to sales multiples, changes in standard deviations of revenues or EBITDA, and change in debt to EBITDA ratio. Another factor could be the presence or absence of specific assets that can serve as collateral. For example, if an acquirer purchases a company with a valuable asset that can serve as collateral, its cost of debt may be reduced. Investment-grade issuers pay particular attention to their investment-grade rating. Investment-grade issuers tend to have much lower WACC than non-investment-grade issuers. A drop in rating to non-investment-grade rating can result in several hundred basis points increase in WACC. As such, their corporate restructuring decisions tend to be geared toward the maintenance of their investment-grade rating. And that concludes our study on the steps to evaluate corporate restructuring decisions. In our next lesson, we shall go through a few examples of the evaluation process. See you again.